Hello, agents. Hello, everyone. So today I'm going to try and make it a little basic. So we're going to look at 3 types of fixed annuity withdrawals you can do and how the cash out works at the end and how the death benefit works, because there's some confusion on that. So let's just jump right into this. And 3 types of fixed annuities, cash out values, and death benefits. How does this all work if you want to draw some income from an annuity? So first we're going to look at the lifetime immediate annuity, right? So we're going to assume a $500,000 deposit, right? So on that, we have a cash value of 0, right? Because immediate annuities don't really have a cash value, and there's no access. So for in general purposes, let's assume when you're looking at an immediate annuity, assume once you give the insurance company the money, you're not going to have access to it again. That's the best way to look at those when you're shopping for them. The return of your $500,000, like how you get it back, is based on the income payments received, how long you receive them, and do they equal your deposit. You could lose premium. You can lose money. So you put 500,000 into an immediate annuity. You could lose if you buy a life only, or you buy one that has a period certain, not long enough to recover the premium deposited, right? It could, though, also guarantee a return of premium using the refund option. Cash or installment are the 2 ways to do that. It just says you'll never get less should you die than your deposit. Or you could guarantee a gain from day 1 using long-term life plus 20 period certain option, let's say. And we'll go into this in a minute, but that can guarantee a gain. And the death benefit is based on the date of death and any remaining guaranteed payments, but it's not going to be a $500,000 lump sum. You're not going to get that money back because it's an immediate annuity and the money's been used to make a payment stream. So now there's some exceptions, as there's exceptions to all rules, right? So exceptions to the cash value and the access to the lifetime immediate annuity is commutability value. Some of these companies have put a thing where you can access some value or pay a charge and get some. Again, you're not going to get your $100,000 or your $500,000 back, except maybe in one extreme case where it equals. A lot of them have an advanced withdrawal benefit, which means if you do the life in 20, you can kind of take an advance on some of those guaranteed payments, but the lifetime will continue after that. Could reduce your payment. Long story there, but yeah, there's some access to that, but still not a $500,000 lump sum at any time. So here's a look at life in 10. So life in 10 here for this particular client, age 65, would give off $28.93 a month times 120 months, a 10-year certain. Would give $347 as the minimum guarantee. Should that person die, say in the 5th year, and they don't make it 10 years, the heirs, the maximum this return is $345. But if that same client bought the life in 20 at $26.55 times 240, the minimum they'll get no matter when they die is $637. In both these cases, if they live to 100, it'll keep paying. But if they die before that guarantee, here's how it would work out. So as you can see there, the life in 10 is, could lose money, and the life in 20 is could guarantee a gain. So that's how that works. The next is a combo split annuity. So with $500,000. Cash value is available on the MIGA, the accumulation side, but no income, no access on the income or SPIA side. So return of $500,000 is guaranteed on the accumulation side, while the SPIA side will dwindle down to 0, making those payments back. And this assumes you don't access that accumulation side for any withdrawals, since it's all coming from the immediate annuity SPIA side. It could lose premium. How? Only if the client violates the provisions they agreed to. So they leave the contract before the term, they take excessive withdrawals above what they agreed to. Sense like that, you could lose some premium if you break the deal. In the end, it will guarantee a return of premium. You held it to term, you kept your deal. At the end, the accumulation side will equal $500,000 in this case, because we put $500,000 in. The death benefit is going to be based on the date of death and any remaining payments. So $500,000 lump sum to the beneficiary is available if they hold it to term. So let's say they buy a 10-year split and the client dies, God forbid, in the 7th year. There's 3 years left. Non-spouse beneficiary just continues the contract. The income's going to always pay no matter what. But if they continue the accumulation side after the 3rd year there, after 3 years of being gone, they continue and they'll get the $500,000 back. So cash out with the $500,000 at the end of term is guaranteed. So here's a look at the split, right? So you have the $500,000 going in. $416,000 is dedicated to the MIGA side, and it'll grow back to $500,000. But let's say you invaded this MIGA side in the third year. Then you'd see in the third year here, this MIGA side, it could have a cash value of only $435,000, or if there's a huge market value adjustment because you're breaking the deal even early, get as little as $337,000 back right there, right? $375,000 back. So we're also looking here at the death benefit. Should the client die in this situation, the account value would be paid. If the beneficiary doesn't decide to continue, they could cash out at any of these values. Again, you're not going to get your $500,000 unless you stay to the 5th year. But those are some options available on that. Next, we're going to look at the deferred annuity, $500,000 of just stripping interest. So $500,000 in this account, and you're stripping the interest of, say, $19,400 a month. So it will return $500,000 as guaranteed, assuming no withdrawals. It's guaranteed the entire time because we're not invading it. You could lose principal only if the client, again, violates the provisions agreed to, and the surrender value, they take more withdrawals than allowed, or they just cash out. They decide to cash out. As you can see, the cash out values are lower than the accumulation values. Now we have the death benefit. The death benefit always equals $500,000. Which is really cool. So if you want a death benefit that equals and no issues for the beneficiary, and you want some income from your annuity, stripping the interest is one of the best ways to do it. It's 100% taxable that way, unlike the split combo annuity where you can get an exclusion on non-qualified money. Of course, qualified money is always 100% taxable. Unless it's Roth, then it's not taxable. And at the end, you see at the end of the term, you have your $500,000 back. So anyway, that's the end. Here's some information. That's the end of my presentation. I hope it's simple. I hope it's basic. Explains 3 different types of ways you can take money through the immediate annuity, where just assume your principal's gone, the split annuity, where assume your principal is locked up for the term, and the interest withdrawals, where you're really accessible and you know exactly what money you have there at any time. Again, thanks for watching. Follow me on LinkedIn and YouTube for the most up-to-date information. I think I need to get some more lighting in here. Call me 1-800-373-9697 for the most up-to-date information too. Remember, no fees, just insurance guarantees. Thanks for watching. Talk to you all soon. Have a great rest of your week. Bye-bye.